suddenly those, especially large asset managers, even though they may not like gold, gold's performing. And so their competitors who happen to be more so in gold or gold miners or silver or related are beating them. So they have to make a decision. And there's a point at which I think there's a psychological hurdle, and I think it's also a technical hurdle, where this gush effect could occur. And I think we're right below it right now.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for January 24th through January 31st, 2023, while supplies last. This week we feature two different kinds of silver buffalo rounds, at just $2.65 and $2.85 over spot per ounce. First, we have our choice buffalo rounds, silver 1-ounce rounds, 3/9 fine in the traditional buffalo nickel design, minted by our choice of respected private mints. These provide a great way to stack 1-ounce silver at just $2.65 over spot. We also have a new take on the silver buffalo, with 4/9 fine rounds from Bull Mint in Bulgaria. Bull Mint pride themselves on artistry and design, and produce a fine silver round with dueling buffalo on one side and a portrait of a Native American chief on the other. These 4/9 fine rounds are available at $2.85 over spot. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Great to be here, Elijah.
Well, it's always great to have you. And we had you just before the beginning of the year, and you talked about how you're very bullish on precious metals. I wanted to get your take on the market movements we've been seeing. We've been seeing an increase in the gold-silver ratio, and really starting the beginning of the year, quite a rally in both gold and silver. Your take?
Yes, I think it's we've got one final launch point. We made our lows in this late summer or September, mostly in many of the gold miners, silver and gold. Turned up, and shortly after turning up, we started issuing buy signals based on various layers of breakout that were occurring using different time metrics, like intermediate trend, longer term trend, et cetera. We've got one more barrier left, and I like what silver's been doing, because silver has been nodding its head at the barrier. And that barrier is up just above 25. And if you look at the action for the last 6 weeks, 7 weeks maybe, we keep getting up around 24.50, 24.70, then they knock you back down, then you cork right back up again, 24 plus. So they can't seem to keep it down. But also it's restrained just below what we predefined as what we would call our final breakout level. Okay. We think when you cross this level, and let's define it in the low 25s, okay? Various metrics come up with different numbers, slightly different, but they're all just above 25. And even the price chart has a parallel channel on monthly price chart. That if you know how to draw a parallel channel, and there's some rules of how to do it, it's pausing at the top of that channel, as if it knows it's there. And I think when you clear that level, I think silver will gush. Now, you can argue right now that silver's already gushed, okay? We were just above 17, and then we shoot up just short of 25, and you do it in a matter of a couple months. I mean, that's a pretty big, huge percent move. Yes, gold has had a big move, but on a percent basis, silver has beat gold sharply over the last several months. We turned positive, technically speaking, on the silver versus gold ratio as of the September close of silver versus gold. We were still way down in price at that time. But since then, silver's gained more. We think that relationship between silver and gold has now shifted back to positive. Now, it's been negative since early 2021. So all during that time period, if you recall, then silver was back up to 30 again in early 2021, after having been at 30 in the summer of 2020. And that second slide from $30, the protracted decline, like from the March period of last year through this late summer low, silver underperformed gold. Coincident with silver also correcting more than gold. on a percent basis. We think that's all changed. So we think that shift in the spread alone, if we weren't looking at anything else, just that, tells us that the net price direction of the two metals is back to the upside. Because the relationship historically between silver outperforming gold or underperforming gold, it happens to be coincident with the net price rise in silver and net price decline in silver. Silver is just the wild dog on a leash. It goes up more, it goes down more. Okay. And right now, I think we're in a positive mode again. We're most bullish on silver, although the mama market is the gold market. So we're constantly watching it. Now, when you look at gold, it's very interesting. If you'll stand back, and we issued this in our weekend report, for example, a simple close-only price chart, where all you look at is the monthly price close. And if you go back to 2000, let's say, 25 years or so, 48 years, and look at the action from gold moving from about 250 up to 1900 plus and then down and, and back up. When we got to the highs in 2020, above, it was 2070 was the high. And again, you hit 2070 in March of last year. So you sort of double topped it there. But if you look at the monthly closes, so far in this rally, we've reached up toward 1950, not quite got to 1950, but the highest monthly close of this entire bull market, measuring from the bear market low in late 2015 when gold was $1,050, okay, so it doubled between there and 2020. But the highest monthly close in that period of time, since the 2020 high, the 2021, et cetera, has been 1970s and change. So we got within 1% or so of making a new high monthly close, and we're 1930 right now. So gold is literally a couple percent away from a new high monthly close for history. So put that into your noggin and think of what's going on here. So the mama market's behaving very well. Silver ratio to gold is broken out and now favors silver. And we think that 2022 was a statement year in the sense that net on balance by the end of the year compared to the close of 2021, silver had an up year by 3%. Compare that to the S&P down 20-something. NASDAQ 100 down 30-something. T-bonds down 30-something%. And gold had an unchanged year. So even though people moaned about gold and silver, if you came in 2021, the end of 2021, and looked at where you were at the end of 2022, you had a break-even year in gold. You had a slightly positive year in silver. What assets in the world had gains last year? Not many, okay? And I think gold and silver know what's going on. And I think that is that they know that this stock market decline is only the beginning of bubble breakage. And that as it gets worse and worse, and the Fed, the ECB, the BOJ, realize what's underneath their feet, quicksand, they're going to have to immediately shift back to what they do best, which is print in all forms. And the longer they delay that, the more urgent will be their need to do that at some future point, a snapping point probably. So I think gold knows that. And it's anticipating events, not waiting for events. So if you wait for, let's say, the Fed to announce, well, we're going to cease raising rates and maybe we'll think about lowering rates. By the time they say that, gold will already know that they're going to do that. It'll already be at 3,000 or 4,000 or whatever. So anyway, that's what we think is the situation right now. The best assets in the world will be gold and silver going forward, with emphasis on silver. We also think that the miners, which vastly underperformed gold in this downturn, gold had a correction, they had a bear market. They've now regained turf very big. I mean, you've gone up more than 50% in the gold miners since the summer low. Nobody's pounding the table about that. More than a 50% move in a matter of 3 months. And we think they will continue to outperform gold going forward as well, just like silver. Anyway, 2023 should be I think it's going to be an historic, dramatic year in a lot of categories.
No, one of the things that surprised me a bit with this rise in precious metals, as you mentioned a little while ago, this huge rise in silver, going from very close to 17 to, close to 25 in a matter of months, as you mentioned. And we've just kind of taken a breather here for maybe a couple of weeks. We really haven't had a major pullback. Is that concerning at all for you, or does that show strength that we're just holding at these levels?
As I defined, there's both momentum reasons for assuming that if we get above 25 by any credible amount, you're going to launch. That's based on momentum factors. And price even has a parallel channel there, such that if you can get up over 25, you can blow that channel out. I'd rather pause before going through that breakout hurdle and rest and relax, R&R, okay, before you go through, so that when you do go through those levels, you've got plenty of energy to run. So the best place to have a pause is right before such breakout levels. Now, this breakout level, not many people are noticing it. I've not seen many other technical reports identifying getting above 25 as a point of upside chaos. We think it is, and I love the behavior here. And gold churning just below a prior peak monthly close. I like that as well, because it indicates they're getting some R&R, so that when they do go through, they'll have the energy to really run. And I think the tone will change. I mean, there's been a dramatic move anyway, from just above 17 to almost 25 in silver, for example, or from $1,613 on gold to $1,900 and almost 50 in a matter of a few months. That's been pretty dramatic. But I think it'll be even more dramatic once we cross these hurdles, where suddenly those, especially large asset managers, who have not allocated sufficient assets out of this category, high risk, low reward, the stock market and other paper assets, and into the better performing assets. When they've not done that, they're in a bad position, because they either have to, shoot or get shot. Okay, they have to join, and so even though they may not like gold, in their guts and in their intellect, gold's performing. And so their competitors who happen to be more so in gold or gold miners or silver or related are beating them. So they have to make a decision. And there's a point at which I think there's a psychological hurdle, and I think it's also a technical hurdle, where this gush effect could occur. And I think we're right below it right now, churning.
And I know last time we had you on, you said really the major story for 2023 is going to be, the Fed possibly pivoting and what the Fed is going to be doing here. We do have the meeting next week. What are your expectations for the Fed meeting next week?
Well, probably what everybody else is, and that's a quarter point rise, which just says, okay, they've been half, quarter now, so they're slowing, but that still that leaves open the possibility of more rate rises, because they're trying to, put the chest out and say, nah, we're tough, okay. They've had an ideal world. We pointed this out in a weekend report, that since June especially, many stock indices made lows in June. Now, some of them made lower lows in September, but marginally. But basically, since June of last year through the end of last year, most of the stock market decline sort of ceased, and we went into a churning pattern. S&P made some good gains, single-digit percent from that low. NASDAQ's trading, several percent only above its June low after, 6-7 months of rally efforts. So you keep getting these rallies, but you do get stability. And so the stock market, I think, will precipitate psychological and market headline type events. And the fact that it's paused has been ideal for the Fed, because it's kept some of these events contained. Now, what do I mean by events? Well, we know that a lot of the major tech companies have laid off, 10% of their workforce. And it's a big chunk. And yet we don't have a recession, right? Okay. The unemployment numbers continue to look good. If you microanalyze them, you'll see that what looks good are the kind of jobs that aren't the best, and so forth. And so that, to some extent, we think is a very lagged indicator. But the Fed, that gives them more room to do what they want to do without having created an emergency. If you suddenly get another decline in the stock market over the next couple of months, where you take out the June and the September lows again, then all of this hopeful buying we've had for 6 to 7 months now, 7 months since the June low, of people buying, thinking, oh, it's a bargain, it's a bargain. Oh boy, this is, that was a correction, et cetera, et cetera. Taking the other side of the argument. We hear the word bottoming a lot on the financial TV shows. There may be a question mark behind it, but at least they're using the word bottoming, okay, which means they still have hope. Only a few of the old timers, asset managers, are saying, no, this is going to be a big disaster. Don't trust this. But a lot of the crowd out there still thinks, no, this is a very hopeful situation. If suddenly you break through the lows in the stock market and demonstrate that after 7 months of a hopeful buying by many investors, that it was a waste of time, that they fooled themselves, then you're going to have the CEOs out there who haven't laid off people, who are going to look over their shoulder and say, you know what, those guys, those other, Microsoft, Intel, et cetera, everybody's laid off major 10% or so of their workforce. And they haven't. They've been sitting on their chair looking at the data points, hopefully not going to get a recession, hopefully don't have to lay people off. But it's in their mind. You break that stock market to a new low, and I think that's going to be a psychological factor that will precipitate a lot of these guys coming off that balance point and joining in with the layoffs. But so I think the stock market to that extent is sort of a creator of events. And I think that the Fed has had it ideal because they've raised rates and that stock market has sort of taken it well. If that stock market suddenly goes into another leg down, and we're particularly watching the banks, by the way, something unusual has happened there. We watched the relative performance of, for instance, KBE, which is the bank sector ETF. It's suddenly gotten sharply weak relative to the financial sector on a spread basis when we plot it week by week. It's suddenly weakened while financials have held. And compared to the S&P, the banks have sharply weakened. What's going on there? No, there's no headlines yet. But suddenly a very important sector that very few people are focused on has gotten relatively weak compared to the market without any real headline events yet. So we think that a rollover in the stock market could be a table turner. And our bet is that if that happens, while that's happening, you'll see silver and gold headed north. And then, and there's another asset category here that's very important, the Bloomberg Commodity Index. The Bloomberg Commodity Index in most commodities peaked in early 2022. When was that? That's when Russia invaded the Ukraine. So this blaming by the authorities of the Russia-Ukraine event as having caused high prices in various essential commodities, like, let's say, energy, is totally false. Oil was exploding for a year and a half before the Ukraine event ever occurred. In fact, about 2 to 3 weeks after the invasion occurred, if you sold oil, you sold the top tick. So anybody who bought the Ukraine war thinking it would propel food prices higher, energy prices higher, you bought the high. Those markets had already been going up for a year and a half since October, a year and a half. We called a major upturn in October of 2020, a year and a quarter before Russia ever invaded Ukraine. And the Bloomberg had already doubled in price from 70 level to 140 before that event occurred. Since then, we've had a correction in commodities where the Bloomberg has pulled back from a peak of 140 down into the 107 low recently. Right now it's 111, 112. So it's been in a corrective mode for almost a year. And we call it a corrective mode because the pullback has not damaged the long-term trends of the Bloomberg. So the Fed has had it ideal that way too, because it looks like, oh, they're winning. Gasoline prices are coming down. Grain prices have pulled back. And so they look like real champions. The stock market has stabilized, not collapsed, and commodity prices have pulled back. What's going to happen if you turn the Bloomberg back up again? We've defined some levels on Bloomberg Commodity Index, which is a well-balanced commodity index. It's not overly weighted with energy. It's very well balanced. It's gotten up to 112 and change recently. You get much above 114, 115, and we argue it's going back up again. The second leg of the commodity bull is going to commence. Well, that will be a big problem for the Fed, because if that starts to occur, the stock market investor, if he starts to see that, like energy, oil go back up to 90 or so. Right now it's in the low 80s, off the low it's 70, okay? You go back up into the 90s again, and suddenly people are going to say, what's going on here? oh my gosh, the Fed's not going to quit raising rates because commodities are reasserting themselves. So we would watch the stock market, because if the commodities turn back up, that's going to cause some investors to think, oh my goodness, the Fed may not let up. The Fed's going to have to play the game some more, in which case they're going to give up on their stock positions. The stock market goes through the low. So watch those events, because I think if you roll the stock market back over after this rally effort, which may have some more rally in it, by the way, and if commodities turn up, those are the kind of events that will spook the heck out of investors because of their perceived impact on the Fed. And I think that will boost gold.
If we look, for example, at the Dow, it's not down a whole lot from its highs, only a few thousand points. You've mentioned, though, that the NASDAQ is really what is leading this, and that's still down around 30 or more percent from its highs. So could you expand on why you think the NASDAQ is the index really to look at right now?
Well, if you go back to 2009, and let's say you went long the stock market, and by the way, MSA issued a buy signal 1 week before the low. We said it would probably go to 670, and it went just beyond 670. And we said this will be a major low. We didn't know it would last a dozen years because we did not know the Federal Reserve would go totally berserk on monetary policy. Fed funds effectively at zero, M2 growing like crazy. It did it for a dozen years. You created a bubble. Look at what happened percent-wise to the various indices. The S&P went up sevenfold from its 2009 low to its 2021 high. That's like double to triple any bull market in the history of the stock market. But the NASDAQ 100 went up 16-fold. It led the bull market. Within the NASDAQ 100, your top stocks, which constitute like 40, 50% of the entire index, or could include things like Amazon, Apple, Microsoft, Google. They're the heavily weighted symbols. They're also heavily beaten down in the recent down move. In the S&P even, Microsoft, Amazon, and Apple, while they don't have the weighting they have in the NASDAQ 100, have a hefty weighting. So they constitute like 20% of the S&P 500. So if you look at those particular major leading symbols that led the upside and now have led the downside on a ratio percent basis, we look at them on annual momentum basis. How do they look when you measure them versus a 3-year average or versus a 36-month average? What do the oscillators look like? They look like the bear market's just begun. In fact, their 30% plus drop has only gotten them through certain levels that are what you could call initial breakage. We think there's a couple more years, or at least another year of decline here of significance. And I'm not sure what the recovery is ever going to look like. Remember, there's sometimes we have bear markets in the U.S. where you don't come back for a couple decades and re-achieve the highs. Like 1929, you didn't come back till 1953. Or mid-1970s, you didn't come back till the mid-80s, okay, and achieve new highs. So it could be that kind of situation. But the leaders clearly have been those heavily weighted names. And they continue to be leaders, this time on the downside. So you can look at all these other symbols you might want to look at that might be doing well, relatively speaking. But the leaders are still very weak on a relative basis. And I think that's what you've got to watch, is don't be impressed by an index like the Dow, let's say, which we don't even look at much anymore. We look at the S&P and the NASDAQ. But look at what the leadership index is doing. And clearly it's like we're trading about 3 or 4% higher than we were at the June lows. It's now 7 months later. Give me a break. It's not a great market recovery. It's a time waster. Anyway, we had one more caution, though, about the stock market. If you're bearish. Now, we're bearish long term, but short term, we're positive in the sense that we know there's a rally underway. There was one attribute that occurs in many bear markets in the stock market that occurs before the debacle, whereas you might make your high and have your initial 1 year of decline or 6 months of decline, like in 2008, for example. You peaked in October 2007 and you made a low in March of 2008, and then you had a rally into May of 2008 that turned heads, because what did that rally do? In the zigzag process of decline that had previously occurred, that May rally took out a prior price high. Not the high, but a prior high. So that when you looked at the price chart, you said, oh, a breakout. Well, if you look at the S&P 500 and go back to 2021, you'll see descending highs. And when you look for 3-week or 4-week rallies and circle the high of each rally, you'll see a descending pattern of highs. The last set of highs in that decline was 4,100 that occurred in December. We're trading at 40.60 right now. We have a suspicion that the S&P may want to go up and take out a conspicuous prior rally high so that the price chartists, the guys on CNBC, the Kramers of the world could all say, oh, look, a breakout. Give them a breakout on price and then let it fail. Because psychologically, the worst thing you can do to a bull to trap him is to give him something that looks really convincingly good, suck in more longs, and then if that rally fails and you slip back under the breakout level and start back toward the lows, that's when you totally create disbelief in the long side because you gave them what they wanted. You even got a price chart breakout. That's what happened in May of 2008. And then after that May high in 2008, that's when the bear market really took hold and you got nasty on the downside. So again, it wouldn't surprise us this rally in the S&P actually goes up and manages to take out that December high in order to beat its chest and say, look at me, I broke out. That's where the real test begins. Because if you find that 2 weeks later you've rolled back over and you're 4,000 and you're 3,900, et cetera, that's when the onset of panic could occur and you get more decisive decline. And that's when the emotion gets pretty big. And I also think that's when you get some headlines.
And it sounds like that's probably when we start seeing even more funds moving into precious metals because they're not the ones declining. It sounds like, Michael, before we let you go, where can our viewers find you online and any last thoughts for our viewers?
It's olivermsa.com. You go to that site and request some samples. There are a few samples posted on the site. Also an explanation of why is our methodology different than orthodox technical analysis. We've been doing it for 30 years, primarily for institutional subscribers, hedge funds, banks, et cetera, RIAs. In 2016, we opened up to retail subscribers. And our main report, we probably issue about 5 reports a week with a large weekend report. We look at all 4 asset categories, especially nowadays when you've really got to look at you can't just look at gold if you're in gold. You got to look at the stock market, you got to look at the bond market, the foreign exchange markets, because they're all interplaying in a way they haven't in a long time, and inversely or coincidentally. And so we cover all 4 asset categories in our regular subscription. And anyway, get some samples and check it out, see what you think. And if you like it, subscribe. We also have a gold silver report, which is more narrowly focused. And we also have twice a month, we have a report on Bitcoin, which we've had for about 1.5 years now. Anyway, so look forward to getting your email.
Fantastic. Michael, once again, thank you so much for your time and God bless.
Thanks, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.